You hit 62 and suddenly the tax rules get a lot more complicated. Not because the IRS is hiding anything, the timing, the income layers, the surprise penalties. It's easy to make a move that feels smart now, but ends up costing you later. So today, I'm going to walk you through 5 tax traps that catch a lot of people off guard around age 62 and how to avoid them. These aren't always obvious, but they can make a big difference in how much of your retirement income you actually keep. Hey, I'm Andrew Rafal, founder of Bayntree Wealth Advisors. And for the last 15 years, we've helped hundreds of clients navigate retirement tax strategies that can avoid costly surprises and make smarter, more tax-efficient decisions. And if you're getting close to retirement, this is the kind of stuff that can make or break your plan. So let's jump in. First up, Social Security. Age 62 is the earliest you can start claiming benefits. But just because you can, doesn't mean you should. If you take Social Security early and you're still working, or even just doing some part-time work, you could get hit with something called the earnings test. Basically, if you earn too much, Social Security can withhold part of your benefit. Here in 2025, it's $23,400 for those under their full retirement age, and it's $62,160 for those reaching their full retirement age in 2025. It's one of those what moments that people run into. So before you claim, make sure you know how it fits into your bigger income plan. Next up, Medicare. I know 62 is still a few years away from Medicare eligibility, which kicks in at 65. But this is when people start making healthcare moves that they don't necessarily age well. Some folks retire early and buy a private health insurance plan, and they may use their IRA or 401k to cover those premiums. The problem is pulling from pre-tax accounts to pay for healthcare can push your income up just enough to cause headaches later. Why? Because pulling from pre-tax accounts boosts your modified adjusted gross income, which can set you up to pay more for Medicare later on. It's called IRMAA, which is short for Income-Related Monthly Adjustment Amount. And if your income crosses certain thresholds, you'll end up paying significantly more for Medicare Part B and D every single month. Here's a quick snapshot of how IRMAA works. If your income is over a certain thresholds, even by just $1, you'll pay extra for Medicare every month. And it's not just a one-time hit. This can actually cost you thousands over the course of retirement. This is why having a strategy so early is so important. If you want to see where you stand, grab our free retirement readiness checklist at the link below. It's a simple way to get ahead of these type of surprises. Moral of the story, healthcare decisions today can trigger tax surprises tomorrow. Okay, this next one, it's a huge opportunity that most people overlook. If you're retiring early and your income drops between 62 and let's say 72, that could be your sweet spot to start converting some of your pre-tax IRA money into Roth IRA. But here's the trap. If you're not careful with timing, you could accidentally trigger higher Medicare premiums or even just pay more in taxes than are necessary. So yes, Roth conversions, they can be powerful, but they have to be done strategically. Now let's talk about layering your income. At 62, you might have multiple income sources, maybe some part-time work, some rental income, IRA withdrawals, even some investment gains and dividends. When all of that gets stacked together, it can bump you into a higher capital gains tax bracket or make more of your Social Security taxable later. It's like a domino effect. The trap here is not thinking about how different types of income interact. It's not just what you make, it's when and how you take it. Finally, here's more of a slower burn, but still a biggie. At 62, a lot of folks build a retirement plan based on today's tax rates and today's expenses. But fast forward 10, 15, 20 years, and the cost of living could be much different, and so could tax policy. So if your plan doesn't factor in taxes or inflation, you might find yourself paying more than you expected, especially on things like required minimum distributions from your IRA later on. So, all right, these are 5 of the most common tax traps that we sneak up on people right around age 62. Here's the good news, though. They're all avoidable with the right type of planning. If any of these raised a question for you, or if you're just wondering what your window of opportunity looks like, this is the perfect time to have a conversation with your financial advisor. The decisions you make at 62 can have a ripple effect for years to come. So having a solid strategy in place can make the biggest difference for your overall retirement future. And hey, and if you found this helpful, don't forget to like and subscribe to our channel. We share new videos like this every week to help you make smarter moves as you head into retirement. Thanks for watching and happy planning, everybody.